When it comes to investing like the rich and wealthy, a quick search here on YouTube will walk you through the traditional ways of investing, such as buying real estate, stocks, and treasury bills. Even though these can be very good investments for most people, most of these have been covered extensively. In this video, we wanted to look at the more exotic and less talked about investment vehicles out there that millionaires and billionaires use. That's why we'll be exploring 5 types of investments millionaires and billionaires make to retain and build their wealth, weigh their pros and cons, and how the average Joe who doesn't have millions in the bank can get started using them. Welcome back to PST Finance, by the people, for the people. Investment strategies vary among rich people, but the stock market is a staple in every wealthy person's portfolio, but where they make most of their money by investing in private equity. Peter Thiel made his billions investing in Facebook, not in the stock market, and so did Paul Graham, investing in Reddit and others more. But the thing is, private equity is not available to everyone, especially if you don't have millions to spare and you are not an accredited investor. This is where equity crowdfunding platforms come in, where you can get invested in companies that are not yet public for as little as $100, gaining the same exposure as billionaire investors. Companies like WeFunder, Start Engine, CircleUp, EquityNet, and many more offer crowdfunding services and allow you to invest in private startups like Mercury Bank, which is raising funds for their Series B. In 2022, Mercury used WeFunder to raise $5 million. It recorded a revenue of $15 million for the same year, achieving a 150% growth rate year-on-year. Now, the pros here are very obvious. Gaining exposure to prominent and promising startups for very little capital is a big one. Getting in at the right time can net you 1,000s of times return on your investment. Imagine getting in on Facebook or Uber before they IPO'd. But before you start throwing your hard-earned cash at the next unicorn, you need to understand the cons. Most startups fail, making investing in them a significant gamble. With high rewards comes high risk, and the majority of angel investors and private equity funds understand and accept that. They invest in hundreds of companies, hoping one of them will succeed and cover all the other losses. For most people, this is not an option, so you should spread your cash in small increments across a few startups. Another drawback is that finding the next hidden gem is as far as it gets from passive investment. You need to do your due diligence, which is easier said than done, given that these are not public companies, so you won't find their statements easily like stocks. Now I'll talk about real estate. I know you've probably heard many people extol the virtues of real estate as an investment, and that millionaires keep 35% to 50% of their wealth in real estate. This is nothing new. If you don't have the money to buy a home, but still want to invest in real estate, then I'll recommend real estate crowdfunding. Just like equity crowdfunding, real estate crowdfunding allows you to become a shareholder in a property and receive returns from the sale of the property based on the amount you invest. Additionally, the property doesn't have to sell for you to receive profits, since real estate crowdfunding also offers profits through property rentals, and you can use that passive income to invest in private equity, for instance, where you can make a lot of money. The pros of real estate crowdfunding are similar to those of equity crowdfunding. You don't need a lot of money. In fact, you can access many real estate crowdfunding platforms, such as Realty Mogul, Yield Street, Fundraise, and others, that set a minimum investment of $1,000 to $5,000. To give you an example of the return you can make using real estate crowdfunding, I'll use Realty Mogul, since it's open to both accredited and non-accredited investors. This website sets a minimum investment of $5,000 for 2 types of investments: an income REIT that is focused on providing monthly income to investors through contractually obligated interest payments, and a growth REIT that provides quarterly income, in addition to focusing on long-term capital appreciation. The income REIT offers an annualized cash distribution between 6% and 8%, while the growth REIT offers an annualized distribution rate of 4.5%. According to the company's website, it has so far distributed $43.3 million to its investors through the income and growth programs combined. Additionally, this type of investment would be perfect for you if you're just getting started in the real estate investment world and would like someone else to be in charge of managing the development of the real estate project. While this sounds good so far, you also need to be aware of the cons of real estate crowdfunding. It is sometimes open to only accredited investors, and while some platforms allow non-accredited investors, they would give you a lower return than you could get if you invested directly in real estate through ownership. Another drawback is that you have to get involved and do enough research to be able to diversify your real estate investments geographically, which is extremely important in the real estate market since some areas perform better than others. Also, it's an illiquid investment since many real estate crowdfunding platforms have minimum terms, often a number of years, during which you're required to keep your money in the investment. In other words, you can't easily resell your investment as you might with a stock. The next investment I'll talk about is gold, which has existed for thousands of years but is still a favored investment by many. Gold's rich history aside, it is used today to hedge against inflation and deflation and as a good addition to a portfolio when diversification is needed. For rich people, it's easy to invest in physical gold since its tangible ownership makes it a safe haven asset. However, for the average person, buying and selling physical gold may come with high transactional fees. Additionally, storing it and keeping it might be a hassle. That's why I'd recommend investing in gold ETFs instead. They are a type of investment fund that holds gold assets, such as bullion or futures contracts, and is traded on a stock exchange just like normal stocks. They are preferred by wealthy and average investors alike because they have multiple advantages, including being cheaper than buying physical gold and way more liquid. Additionally, gold assets would have low correlations to other portfolio assets like stocks or real estate, so they're perfect for diversification. However, you must also be aware of the disadvantages of gold ETFs. For starters, they are not tangible assets unlike physical gold, which may be risky and uncomfortable to some investors during volatile market conditions. Also, if you invest in a gold ETF, you could be exposed to counterparty risk, meaning that if the ETF's issuer faces a problem and defaults, you could lose some or all of your investment. Finally, while the prices in a gold ETF move directly with the price of gold, gold ETFs may not be able to track the price of gold perfectly, which could lead to investors not getting the full benefit of a rise in the price of gold. As for gold ETFs you could deal with, the largest by a wide margin is SPDR gold shares. Even though it's not the cheapest option based on annual expenses, which are 0.4% or $40 for every $10,000 invested, it makes up for it by being the most established gold ETF, with an average of 10 million shares traded daily. If you're looking for a cheaper option, then you could go for the smaller SPDR Gold Minishares Trust, whose annual expenses account for 0.1% and trades for about $37 per share. The next market the ultra-wealthy loves to invest in might appear like a hobby or an indulgence at first, but it has existed for years and is constantly growing. This market is the blue chip art market. The term blue chip is used to describe companies that are so big that their value is a certainty. In the same light, blue chip art is art by important and famous artists whose pieces always sell at high prices. For example, one of the best results in the blue chip art market in 2022 was the sale of Paul Cézanne's La Montagne Sainte-Victoire. This beautiful painting was acquired in 2001 for $38.5 million and resold 21 years later for $137.8 million. Since this market has an established base of collectors, it's rarely affected by global conditions. For instance, it's one of the few markets that was not affected by the 2008 financial crisis or COVID-19. I know by now you must be thinking about how nice it would be to own a few $1 million to invest in fine art, but the main benefit of this investment is that you don't actually need that much money. In fact, you can invest in blue chip art by using recently emerged art investment platforms, such as Masterworks and Artbank, and own a fraction of a Picasso painting for as little as $20. Then profits would be distributed once the painting is sold based on the amount you invested. However, fine art investments also have their disadvantages, and you should be aware of them before you decide to use any of those platforms. Firstly, the art market can be volatile and even fickle at times, so it's important to do your research or even seek professional help before making a bet on the right artist or piece. In other words, this is no passive investment, and you need to put in a lot of effort to make it work. It's also important to note before you make the decision to invest in fine art that it is taxed as a collectible, meaning that it is subject to a long-term capital gains tax rate of 28%. That's higher than the long-term capital gains tax rate on conventional investment assets, which reaches 20% for the wealthiest Americans. Our fifth and final investment rich people love to make is buying collectibles. Collectibles can be defined as anything that has the potential to increase in value over time. Therefore, they can range from old books and coins to toys, vintage cars, and investment-grade wines. The cons for investing in collectibles are quite a lot, since this type of investment is accompanied by risks such as paying high maintenance costs, buying an unauthentic product, and getting scammed. So they involve a lot of research and expertise to determine if the product you have is the real deal. Additionally, they're illiquid investments, and you can't sell them immediately whenever you need money. But they also have advantages that could justify the high risks, such as allowing you to invest in things you're passionate about and being able to be passed down to future generations. They could also give really high returns, depending on the item. For example, in 2022, at Heritage Auction, which is the world's largest collectibles auctioneer, a single comic book page from the 1984 edition of Spider-Man sold for a massive $3.6 million. If you're considering investing in collectibles, you might want to start with comic books or coins. Some rare coins, like the British 2008 pound coin, could make you a big profit in a few years. However, if you're not willing to wait a few years, you can look for rare but less valuable coins, like the 2009 Kew Gardens 50p coin, which was released in a limited edition of 200,000 coins and typically sells for £100 to £150. Many people might think one investment is better than the other, but what is agreed upon is that you can't build wealth without having a diversified portfolio of different investments in order to reduce risk. As time goes on and technology advances, diversifying becomes easier as many investments that were once for the rich only become more open and more accessible to the everyday person. In addition to diversifying your investments, you need to be aware of the potential risks, especially if you aren't a professional investor. It's important to know that general market risks affect nearly every stock, so diversification should go beyond industries, asset classes, companies, and geographical locations. Thank you for watching and see you in the next video.